What did you make of Fed Chair Powell's comments last hour? Did they surprise you at all in terms of its hawkishness and potentially speeding up the taper? What does that mean for tech stocks?
Yeah, first of all, thank you for having me. It's great to be back on the show. My first hit since joining Wells Fargo, so very excited to be here. As far as the comments and what we've been seeing, I think you want to pull the lens back just a little bit first. The first thing to realize is, the S&P is up 23% this year or so, NASDAQ up 21 or so percent, and that's coming off years since pre-COVID, up 60% for the NASDAQ and 40 for the S&P. So you've had a tremendous run here. And obviously investors are thinking a lot about inflation, the new variant, but really going after growth and new TAMs and new opportunities. And tech has outperformed the S&P over the period since pre-COVID, as well as this year, as well as you see investors looking for new growth parameters they can get and new capabilities they can't get in the non-growth sector. So I think you're going to see tech continue to outperform here. You've heard us talk before about the COVID bucket or the work from home bucket. COVID being a collaborative software and security, online commerce, video gaming, in-home services and delivery. What's amazing when you look at that bucket is, yes, it's up 140% from pre-COVID levels and 250 from the bottom, but still up 15, 20% this year, trailing the S&P a little bit, but still doing strong. So I think you'll see investors continue to look for new tech ideas.
Right, that COVID basket and some of the darling names in that basket saw a huge run last year, but as you said, they've come off their high. Where do valuations stand from your point of view? I know you said that you think that some of the COVID accelerated themes will continue into next year. Is that the case if we get a sped up taper and rising interest rates next year?
Yeah, well, when you look at valuations, let's look at the S&P just in general, you can see that the PE ratios are up a couple of turns, right, from the high teens to the low 20s. Same, by the way, with revenues and EBITDA, up a couple of turns. What I think is interesting is you look at throughout this year, those multiples have been very stable, right? So they increased going into 2021, but have been stable sort of throughout the year. And more importantly, throughout the year, starting in about April, you start to see a lot of earnings revisions to the upside, right? So you've had earnings growing faster. So therefore, when you look at these numbers on a growth adjusted basis, you're looking at pegs around 1.3 or so, which is lower than where it was at the end of 2019. So I don't think you're seeing valuations get egregious. I do think you are seeing investors being discerning, looking for particular names where they see recurring revenues, large TAMs are going after disruptive ideas, and really trying to pick the names they want to be a part of.
Hey, Bob, it's John Fort. Welcome. I think it might be a stretch, though, to say that even at the end of 2019, the valuations were seen as sober. So I wonder, how much do these new TAMs justify the new multiples? And is there going to have to be a lot of M&A in 22 consolidation-wise to fuel some of these names that are going to continue to be successful, perhaps?
Yeah, it's a great question. And just putting it in perspective, those pegs of around 1.3, once again, looking at it at growth adjusted, puts you easily in line with where you were in 2018, 2019. So it's really the growth aspect there. And once again, I think they'll be on a case-by-case basis, right? What is the actual TAM you're going after? Is it EV? Is it Internet of Things? Is it AI? What exactly are you targeting? M&A, though, you raise a really good point. So as you probably know, we have 4.7 trillion of M&A this year globally. It's the all-time record in M&A. And in the U.S., we're on pace for about 2.3 trillion. Another phenomenal year. So M&A, I think, is going to continue to be a big factor going forward. There's a couple things driving it, right? One is you've seen the PE and strategics with tons of cash on their balance sheet. The tech strategics are looking for further ways to get engaged with their customers and better serve their customers, sort of filling out their portfolio of offerings. But the non-tech companies are trying to get more into tech as well, as they see it as paramount to their future. So you're seeing it across not only the sponsor group, but strategics in tech and non-tech as well. And when you look at the premiums that have been paid so far, pretty consistent with the past in 25% or so premiums, so not egregious. I think the big question there on the tech side of things will just be, what can the large tech players do?